Welcome, everyone. My name is Kevin Castor. I'm a cattleman from Parkfield, California, and currently serve as chairman of the Policy Division of the National Cattlemen's Beef Association. I'm very pleased to welcome you to the NCBA's webinar on transportation, trade, and tax policy. As a participant, your line will be muted, but feel free to type in questions in the chat box on your screen, and at the end of the presentation, questions will be moderated to our presenters by Josh White, part of our NCBA producer education team. If you have trouble with your technology, or if you are joining us only for the audio, the webinar is being recorded and will be available in a few days at beefusa.org. With several speakers joining us from across the country, bear with us as we change control of the presentation during the course of the webinar. There may be a brief pause in discussion. We do have outstanding speakers who will provide us with the most up-to-date information. CPA Larry Kopsa, a principal in the firm of Kopsa Odie in York, Nebraska, will be participating in the program. Larry is a well-known educator and speaker on tax issues for small businesses, including farms and ranches, and he will provide some practical advice for us tonight. We also have Colin Woodall from the NCBA Washington office. He's the Senior Vice President of Legislative Affairs for NCBA. But we'll start our program with the latest policy news from Kent Bacus, Associate Director of Legislative Affairs for NCBA. So Kent, it's all yours.
Thank you, Kevin. As Kevin mentioned, tonight's webinar is going to cover transportation, trade, and tax issues. We're quickly going to discuss the transportation, which has been a very hot-button issue for the last few years. Unfortunately, Congress has not been able to pass a multi-year highway bill for several years, but they were able to manage one to pass one here in the last few weeks. And so last week, Congress passed a 5-year highway bill. What this does is it not only addresses the funding needs for our roads and bridges, it also addressed some rail issues as well as a lot of other critical infrastructure needs. The only positive point we could really find in this bill that is attributed to the livestock industry is the fact that the highway bill did include a permanent exemption from the 30-minute rest break requirement for livestock. As you may have been familiar, for a few years we had some uncertainty in our transportation laws, and so a lot of people who are doing long-haul shipments of cattle would have to build in 30-minute rest breaks, or government-mandated nap time, as we like to call it. And fortunately, NCBA was able to work with other members of the livestock community and address this issue with the U.S. Department of Transportation and get some short-term exemptions and some short-term relief from this onerous regulation. Well, fortunately, Congress came to our aid, and in this highway bill, they made that exemption permanent. So this is no longer an issue for those of us who are transporting livestock and have to abide by the hours of service rules. Unfortunately, our top priority, truck weight reform, was not addressed in this latest highway bill. We did manage to have 2 separate votes on amendments. One would allow states to have the option to increase truck weights up to 100,000 pounds with 6 axles, and the other amendment would allow trucks a waiver to haul livestock on trailers up to 95,000 pounds. Unfortunately, opponents of truck weight reform prevailed, and we were unable to secure real reform in these bills. It was very disappointing because we had facts and we had science on our side, and unfortunately Congress took the easy way out and As a result, we continue to operate under 30-year-old truck weight rules. So we expect there to be more hearings from the ag industry to discuss transportation rules and transportation needs. And truck weights is definitely something that we're going to continue to try to educate members of Congress on this issue and hopefully find some kind of relief and reform, whether it's in another highway bill or any other piece of legislation where we can find relief. On to trade. I'm going to pass this over to Colin Woodall. He has been the lead for NCBA on the country of origin labeling issue for quite some time, and Colin has some information to share on the latest updates with country of origin labeling.
You know, country of origin labeling, or COOL, has been an issue that we have dealt with for almost 20 years now. The congressional action dates back to the 2001, what ultimately became the 2002 Farm Bill, and we have been working in different variations of that program ever since. The current version is a result of language that was included in the 2008 Farm Bill, which was ultimately implemented. And as of today, you can see country of origin labeling labels on cuts of beef, and it's been that way for about 6 years. But one of the problems was what it did to our trading partners. Canada and Mexico both claimed that country of origin labeling violated our trade agreements with them. They made the case that because of labeling, their cattle were being treated differently in the form of discounts being paid just because those cattle were born in Canada and Mexico and not the United States. Within trade agreements, there is a provision that talks about national treatment. And under that provision, it basically says if you have trade agreements with other countries, you can't treat their products differently. It was that national treatment argument that was used with the World Trade Organization. And over the course of the past several years, there have been 4 decisions by the World Trade Organization against the United States. Now, a lot of people sometimes ask, why do we worry about the WTO? Well, we worry because the United States is a member of the World Trade Organization, and the World Trade Organization, like this, can levy retaliatory fines or tariffs against offending countries, ones that violate the trade rules. And that's where we find ourselves right now with this WTO case that was filed by Canada and Mexico. On Monday of this week, the WTO came out and said that Canada and Mexico will be allowed to retaliate against the United States at a tune of $1 billion. It's a billion with a B. That is a significant amount of money that can be used against the United States economy. Now, we expect that once the list of retaliatory tariffs come out, that beef will be on the list for both Canada and Mexico. We won't know exactly what that number looks like until the list comes out, because we won't be the only product on that list. We expect the list from both Canada and Mexico to include many products, including things such as fruits and vegetables, ethanol, wine, manufactured goods. So beef will be only one portion of that. That's why we can't give you an exact dollar figure yet. Not to mention that the way the trade deal is set up, the way the WTO works, Canada and Mexico can implement what is called carousel retaliation, which basically means they can start out retaliating against a certain set of products, and then within 3 or 6 months or more, they can change that list of products. And the goal in doing that is try to maximize the economic harm to the United States economy in order to get the United States to change their policy. Now, we do have the opportunity to stop this, because there is a small window of time that exists right now, and that is the time between the announcement of the $1 billion, which came out on Monday, and the first day of actual retaliation, which at this point in time we expect to start on Friday, December the 18th, and no later than the following Tuesday or Wednesday. So this will be right before Christmas, and this is definitely not a Christmas present that the U.S. economy needs. However, if Canada and Mexico are satisfied with any changes made to this program, they can drop their case. And that's where we find ourselves right now. We are working with the U.S. House of Representatives and the U.S. Senate to try to find a way to stop retaliation. Canada and Mexico have told us that the only way to do that is to repeal country of origin labeling. Back in June, the House of Representatives voted to repeal country of origin labeling, and they did so with 300 votes in support of that proposal. And those were Republicans and Democrats alike. We've been waiting for the Senate to act, and in many cases we had some senators who were hiding behind this retaliatory number. Many of them did not think it would be over $1 billion. In a lot of cases, there were some senators that didn't think there would be any retaliation at all. Now that this number is out, we have their attention. They have changed their minds, and many of the Democrats on the Senate side have now decided that we must repeal. Now that we have the Congress a little bit more focused on repeal, the question is, how quickly can we do that? The only vehicle, and this is a legislative vehicle, the only vehicle that will be leaving the station here in Washington, D.C. before the end of the year is the fiscal year 2016 Omnibus Appropriations Bill. This is legislation that funds the government for the rest of this fiscal year, so through September 30th of 2016. Since it is a piece of legislation, it can also be utilized to attach other items to it. And that's where COOL comes into place. This bill could hold a repeal of country of origin labeling, which would stop this program. We would be able to show that to the Canadians and Mexicans, who in turn could stop this case, drop this case, and not retaliate against us. It's important that we get it done, because retaliation from Canada and Mexico, which are two of the top 5 markets for the export of U.S. beef, would be a negative impact on us as U.S. producers. Because if we don't have access to those markets, where are we going to go with the rest of that beef? So that means that we're going to see downward pressure on prices across the board. That's just not something that we can stomach right now when you see everything else that we have dealt with in the futures. And it's also a signal to our current trading partners and future trading partners that we may not live up to our trade obligations in the future. So again, another reason why we need to repeal country of origin labeling. We expect to find out more throughout the weekend as Congress stays in town to work on this bill. As of right now, we expect to see a copy of this bill sometime late on Monday, with a vote Tuesday or possibly early Wednesday before they go home. So a lot is riding on a COOL repeal, and we need to make sure that you are engaged. So one thing that you can do is call both of your senators and your member of the U.S. House of Representatives and tell them to support full repeal of COOL in the Omnibus Appropriations Bill. They would be more than happy to listen to you. I can tell you from having worked in the congressional office in the past that members of Congress always know who is calling in, and they know which issues are being talked about. So your call does count at this point in time, and we would encourage you to do that. Kent, I'll turn it back to you.
Thank you, Colin. Another major trade issue that we have been working on is the Trans-Pacific Partnership, otherwise known as TPP. Negotiations concluded on TPP in October, and as part of the next steps under Trade Promotion Authority, it's now up to President Obama to sign the agreement and send it to Congress for further fast-track approval, and we're hopeful that that will happen sometime in 2016. It's important you understand what TPP looks like, and and it's also important that for those of you who are aware of it, you need to speak up. You need to be in full support of this trade deal. Opposition's been very vocal, both labor groups and the Tea Party on the right. And so it's very important for us to speak up as a beef industry in support of this important trade deal. So why should we support TPP? Well, first and foremost, the tariff relief under the Trans-Pacific Partnership is amazing. It eliminates most of the tariffs on U.S. beef, and it reduces Japan's tariffs from the massive 38.5% rate where it sits right now to 9%. This is the greatest market access that's ever been negotiated into the Japanese market. And without TPP, our competitors will continue to take our market share. We'll be able to take more of our foreign consumer base. It's important you understand that right now, Australia and Japan have a separate trade agreement in place. And under this trade agreement, the Australians have about an 8 to 10% tariff rate advantage over U.S. beef into Japan. And you consider the strength of the U.S. dollar, that makes our exports less attractive, makes us more expensive into Japan. And when you couple that with the higher tariff rate on our product, we are losing market share to the Australians in Japan every day. Every day that goes by without TPP, our competitors, the Australians and some of the other major markets out there, will continue to take U.S. market share away from our producers. TPP will level the playing field. TPP allows the U.S. to set the terms of trade for beef in the Pacific. The TPP will allow us to be able to compete not only with Australia, but with every other major exporter. And the important thing is that without TPP, other countries will continue to strike bilateral deals with the Japanese and try to take as much of our market share as they can. So a lot of times when we talk about trade, opponents and people who are unfamiliar with the trade agreements ask if we should be concerned about the imports that would come as part of a trade agreement. And so should we be worried about imports from TPP countries? And the simple answer is no. When you look at the food safety side, all beef that will be imported in the United States has to meet the same rigorous safety standards as the beef we produce. So when you go to a grocery store or go to a market, order a steak at a restaurant, you know with certainty that regardless of where that beef comes from, that food had to meet the same safety standards as the beef we produce here. Now, in all fairness, the quality is not necessarily the same, but the safety standards all have. The U.S. already has some of the lowest tariffs on imported beef, and that's also an important factor because it's not like we're going to be giving up massive protections on our market. In fact, we import record volumes of beef, and we do that in order to combine the leaner grass-finished beef from Australia and New Zealand with the excess trim and the fat from our beef to meet the growing demand for the commercial ground beef market. So when you go to fast food restaurants and places like that, that is where a lot of our imported beef is consumed. What that means for us is that we're taking those same muscle cuts that would normally go in for grinding purposes, and we're selling them at higher premium values into other markets, whether it be selling short plates, short ribs into Japan and Korea, or if it means we're taking chuck rolls and selling those instead of grinding them up. This is a prime example of the same muscle cut we would use for grinding beef we're using to make flat iron steaks. So the value add for U.S. producers is more. That means that our beef is more valuable. So imports, we shouldn't be afraid of these. We should make sure that if we're allowing that access to the United States, then we're getting better access to other countries, and that's exactly what TPP does. Remember, this is not about tearing down tariff rates in the United States. Our rates are already very low. This is about tearing down massive tariff rates overseas and letting our beef compete on a level playing field for foreign consumers. At the same time, there are some who think that we should wait and we should renegotiate under a new president or a new Congress. I think this is very dangerous. We'll be the first to admit that TPP is not perfect, but it sure is a better agreement than the status quo that we currently face. Our competitors continue to take our market share with each day that passes, And if we continue to delay action on TPP, then it's going to be very hard for the United States to continue to lead in the world of trade. As a matter of fact, China is currently working on a separate deal very similar to TPP that does not include the United States. So if the U.S. fails to move on TPP, then it will be China, not the United States, that's setting the terms of trade in the Pacific. And keep in mind, the Pacific is host to some of the fastest growing economies and largest consumer bases in the world. On the tax front, this is something that strikes home to every single one of us. We are currently dealing with an expired tax code, especially with important provisions that have been included in the extenders packages in the past, including the Section 179 small business expensing, child tax credits, but also bonus depreciation and the conservation easement tax credit. Currently, there are some ongoing negotiations between the House, the Senate, and the White House. There are efforts to try to include a permanent extension of some of these provisions. And at the same time, there's also negotiations for a simple 2-year extension package that would be retroactive for 2015 and reauthorize everything through 2016. So the question is, when will they finally move forward with an extenders package? Well, the good news is that a lot of the impasse that we've been seeing was from the Senate side, and the Senate and the White House have agreed on a few permanent extensions of some of these provisions. We don't know yet for sure what some of these provisions are, but it has been speculated that Section 179 would be included in that package. We cannot confirm that yet, but this is something that NCBA, the agriculture industry, has been moving very hard to try to secure. It is unlikely that we will see a permanent extension of bonus depreciation, given the very expensive price tag that would carry, and the threat of the White House veto. So we are looking for tax extenders to either be a standalone piece of legislation that could be voted on early next week, or it could be lumped in with the larger Omnibus package. So this is something we definitely need you to engage on. We certainly need you to call both of your senators and your member of Congress and tell them that we need tax extenders. We need a multi-year tax extenders package approved before they come home for Christmas. And if they don't approve one, don't bother coming home for Christmas, because this is something that affects every single one of us, and it also is critically important to the future success of our businesses. In regard to greater tax reform, I think that ship has sailed for the rest of this Congress, but we are continuing to lay the groundwork on many areas. We encourage you to keep informed and stay engaged, and hopefully with a new president, we will be able to tackle some of the longer-term issues like estate tax that have been plaguing us for many years. So with that, I'm going to turn this over to Larry. If you'll be with me just a minute here. Okay.
Well, good evening, everybody. I'm really honored to be here today. Man, a lot of information coming out already. As I mentioned earlier, I'm Larry Kopsa. I'm a practicing CPA. We're located in Nebraska out here in the Midwest, and we have 25 people working our firm, and we're busy right now working with our ag people, trying to get them set up for the end of the year. Over the next few minutes, what I really want to talk to you about is some of the items that we're discussing with our farmers that and our producers that they need to know about, that are maybe changes or things that that they need to make sure they're taking into consideration as they go into the end of the year. Certainly over the next few minutes I can't do a complete summary of taxes, but I'm going to talk about 3 or 4 things that I think are really, really important. So be an issue spotter as you look at this. Congress in action, as I just mentioned, is really making life difficult for us. And so we'll talk about some things. So be an issue spotter as we go through this. Now, I always start out talking about taxes, and I always point this out, and this is our tax system right here. If you rob Peter to pay Paul, you're always going to have support of Paul, and that's one of the reasons taxes are so confusing, because there's a lot of more Pauls out there than Peters. Actually, Hank Williams Jr. said it better than me. He said, "Let me sum it up this way for you. We got some people who work for a living, and we got some people who vote for a living," and that's kind of what makes this difficult, because we have so many different provisions that come out all the time. So anyway, what about these 55 different phased-out items? You just heard the experts on this, and it's one of the things we're looking at. The past couple of years, what they've done is they've just took all 55 of them and voted them on at once. Now, maybe they'll take a few of these out. We have no idea what they're going to do. The things that are important to us and our farmers are certainly Section 179. I'm going to talk about that a little bit. And 168, I'm going to talk about the bonus depreciation, talk about that a little bit. We have some of our producers that are over age 70 and a half and are having to take required minimum distributions from their IRAs. There's a really cool thing that they can do by giving that directly to charity, as opposed to taking the money out and then giving it to charity, that really can help them from a tax standpoint. That's in amongst those 55. Conservation reserves in there, research and development, and many other things, like really important things like the $250 deduction that teachers get on the front page of their tax return if they buy supplies. It's some crazy things in there, to be quite honest. And so those are the few that we're worried about as we go through this. So what are we having to do as we deal with our farmers and our producers? You know, we have to have 2 plans. We're meeting with people all the time right now. This is our busy time of year, November, December, when we're planning. And we're saying, okay, if they pass 179, we can do this, and we will set our system up like this. But wait a second. Plan B will be if they don't pass it, and then we'll do it like this. And Plan C is if they pass one but not the other, and how's it going to do? And so we're sitting out there with 3 tax plans. When somebody walks out of our office, they're walking out with 3 tax plans. Normally, it's 1, 2, or 3, and we'll call you once we hear what Congress is doing, and then you can start writing checks or making deposits or doing whatever you need to do to get your taxes where we want to have them, so that we're set up within our tax plan. Man, what a way to run the country, huh? So, mention 179, just as a real quick summary of 179. Right now, it's at $25,000 is the maximum, with $200,000. It phases out at $200,000. So it's been prior to 2007, before we've seen such a low number. You can see the numbers here on the screen as they went up here. 2012, it was 139. About mid-year, they said, no, make that 500,000. 2013, I think actually in January, they retroactively passed it. In January of 14, they retroactively passed, or signed the bill anyway, for the full 13 to 500,000. 14, it was right around Christmas time, about right now when they passed it, and here we sit. And so we don't know what we're doing here. Now, of course, Section 179, that's for new or used equipment. It's just the boot. We can pick whatever amount we want to. So if they pass it and I purchase $100,000 of equipment, I really only need $60,000 worth of depreciation, I can take that amount. So it's a really nice, I call it a faucet, that we can kind of turn on and off to drop however many dollars worth of deductions we want. And, the strange thing about it, this whole Section 179 replaces, some of you guys have been around when old investment tax credit was around. This was a replacement to investment tax credit many, many years ago. And the strange thing about this, the reason these numbers are out here is to encourage us to acquire things. Well, wait a second. If I'm purchasing something, and the law isn't out there, it's really kind of a gift, and it really is something that needs to be looked at as I go through. The other thing about 179 that affects us a little bit is it does not qualify for for landlords, for anybody that's renting property. They can't take Section 179. Very, very rare that they could take Section 179. So that's what 179 is, and it's not there right now. And for those people that are, I know you're not going to write this down. I'm going to go off this pretty quickly, but for those people that are picking this up off of beefusa.org, I kind of highlighted in red here those items that affect our producers, our ag people as much as anything else, and these things all qualify for Section 179. And so again, it's just the boot. And so if I trade in something, it doesn't qualify. If I trade in something that has a basis on my depreciation schedule of $5,000 plus $50,000 cash, just $50,000 qualifies for Section 179. So it's a little bit of a complicated thing. You guys have been dealing with it for years, and so you should be pretty well aware of it. Bonus depreciation. This is a big one, and if you go back to that Section 179. If they go back to $500,000, if you purchase over $2 million worth of stuff, you phase out. So the big corporations don't get Section 179. They don't care about that. They purchase over that much stuff. But bonus depreciation has no limit, phase out limit. And what this is bonus depreciation, you can take 50% of the cost, including your trade-in. So 50% if it's new and placed in service during the year, and most farm items, including buildings, are going to qualify for this because most farm items are 20-year or less property, so they qualify. So this is really important to us, because there are two really categories of farmers that are interested in this. Number one is machine sheds and shops. Normally that's a longer period of time. You got to depreciate over a 15-year life. Don't qualify for Section 179, but this building here would qualify for 50% bonus depreciation. That's a big deal. It affects people that are buying that, and that's why over the last couple of years you see a lot of new buildings going up around the country, because it does qualify. Flat storage does qualify. So that's one thing. The other thing is, and as I mentioned earlier, landlord improvements. See, if I am a landlord and I put in some equipment, I don't get 179, but if it's new, I can take a 50% on bonus depreciation under 168. So those are two things that we're looking at, and as you can imagine, our ag people have all of those things going on right now, and so that's why we're sitting out there with 2 or 3 tax plans for everybody as I go through this. So talk to your tax guy about these things to make sure that you know exactly where you are. And I should mention, it has to be placed in service. It can't be just purchased. And so every once in a while somebody say, well, I'll go ahead and write the check. And no, it doesn't work. It has to be placed in service this year. So we're getting pretty late in the end of the year. But if you did have purchases, it does qualify. Here's the new one that we had, kind of new, I guess. Back in 2013, IRS very, very onerous rules about property, plant, and equipment. And in the old days, that would be prior to 2013, everything was expense unless you had to capitalize it. Well, that just flipped over the way I looked at it in 2013, starting in 2014. Everything was capitalized unless it met the qualification to be an expense. What had happened, the IRS had lost some really big cases on jet engines and the like, and they didn't like that, so they just changed the rules on us. Well, one of the things in the rules, I don't know who wrote these rules. I mean, there were pages, hundreds of pages of rules. But one of the things in the rules, it said, unless you were a big company that had an audit, which most our ag people don't, if any, the threshold is $500. So anything over $500, you have to capitalize. Unless it was a repair, unless it was a true repair. But then they had this crazy definitions of improvements that a lot of things that I would call repairs were improvements. And back on November 24th, just a few days ago, IRS raised this, what they call a de minimis safe harbor threshold, to $2,500. That's a good sign, kind of. I'll talk about that in just a second here. That's kind of a good sign, because now, if we call that the capitalization policy. If my capitalization policy says anything under $2,500, I'm going to go ahead and expense, because it's not worth keeping track of that That's a good thing. And so it's out there, and IRS said, you know what, this is effective for 2016, but you know what, we're not going to really pay too close attention in 2015. Okay, so that gives us a little bit of wiggle room here on items, but there's some dangers here. And some advantages to this. Those people that have, well, let's go to the dangers first. So there's some dangers here. Okay, so if I put this in my policy and I make this election with my tax return, I have the policy at the beginning of the year that says my capitalization policy is $2,500. What if I purchase a $2,000 welder? Okay, that's under $2,500. My capitalization policy said $2,500. That means if that's my policy, then I have to expense that welder. Now maybe that's a good deal, because one of the reasons that's a good deal is because then that welder is not going to be on your personal property tax, on your depreciation schedule, and those people paying personal property tax, they may avoid the personal property tax on the welder, but it is an issue that we look at because, you know, $2,500, it could be $2,000, it could be $1,500, it could be $1,800, or you could use $500 if you want to. And it's an election you make, it's a policy that you create every year. So I could be $2,500 this year, and I could be, you know, $800 next year if I want to be. So that's where we are, and that gives us some really good advantages here. Now, what about you guys? What about you livestock producers? Well, of course, you know, feeder livestock, you're purchasing that. There's no change in this. You're purchasing that for resale. That's inventory. That doesn't count. That doesn't make any difference. You're purchasing feeder cattle for fattening and resale. That's inventory. That doesn't count for this. But look what does count. Breeding stock. So if you're purchasing breeding stock or dairy animals, they qualify for this de minimis test. So anyway, if you purchase something per head under $2,500, you don't have to capitalize that. Okay, so what you can do, you can just turn around and you can say, hey, I'm going to expense that out. But this is where you need to be real careful, because if you do that, you say, hey, that's great. I purchased 10 head. That's $25,000. I'm going to expense that out this year. Okay, but what happens when you sell them a couple years later and you sell them at a gain? Okay, now, if you didn't capitalize them, then that becomes ordinary income to you, and you don't get the lower capital gains rate of 15% or lower, maybe, and maybe even worse, it goes on your Schedule F if you are a sole proprietor farmer, and you have to pay self-employment tax on it of 15.3%. So we have to be careful when we look at breeding stock, and because maybe we don't want to put that on our. But wait a second, didn't I say before, if my policy says $2,500, you know, maybe you have to put your capitalization policy. We don't know. This is brand new. Maybe our capitalization policy needs to say, hey, equipment, but is a different threshold. So it's new. It's something we're looking at. It's something that we're trying to figure out, and it works into our planning process now as we get this late information on this $2,500 as opposed to $500 limit. Just briefly, CRP payments, because there's a change there. The CRP payments, there was a person by the name of Morehouse who, I think it was a Minnesota guy, that what he did was he rented out some land, and he put some land in the CRP program. And he says, you know what, that's rental. And so he put it on his Schedule E, if you want, or 4835, and he didn't pay Social Security tax on it. Well, the IRS steps in and said, hey, no, CRP payments are subject to Social Security. He said, yeah, but I'm a landlord. It doesn't make any difference. And so off they go to court, and they bounced around courts for a few years, and I think in about 2006, finally the court said, you know what, this looks more like rent, and so therefore in our 8th district, Arkansas, Iowa, Minnesota, Nebraska, North Dakota, South Dakota, in our district, if you are in a CRP program and you're a landlord, not if you're an active person, if you're a landlord, you don't have to pay Social Security tax. And so that was out there. We weren't sure what the IRS was going to do until September. On September 23rd, IRS came out and said, you know what, we're not going to follow that. We're not going to follow that provision because we don't agree with it. They call it non-acquiescing. And so we're gonna in every other district, we're gonna charge self-employment tax on CRP payments on landlords, and then we'll all go to court and we'll finally figure out what's going to happen. Maybe this is one of those things that gets to the Supreme Court. Now, one of the things that I just talked to my staff about today was, if we have any of our farmers, we have some farmers that are outside our district, if we have any of our farmers that qualify for this, then if they're outside the district, then the IRS's rules are outside our district that they have to pay self-employment tax. So there's a disclosure statement that we should put with the tax return. They need to talk to me. It's got an 8275 form they should put with the tax return. And the name of that form is disclosure statement, but really the name of that form is, would you please come and audit me because I did something that you don't agree with, but I think I'm right. And so anyway, if anybody that's running into that type of thing, they probably need to make sure they're talking to their advisor and know what's going on so that they are making the right tax moves. Then, this is a big one here, and those 1099s have been around for a long time. You know, that's how we audit ourselves. We audit ourselves because we send 1099s. Anybody that I have business expense for services, not materials, services, over $600, I'm required to send them a 1099 form by January 31st. And that form should say, hey, this is how much I paid you for services. Oh, I don't have to send it to corporations, just individuals. So if I have somebody come in, and I'll use painting, for example, I have somebody come in and paint one of my buildings, and they send me a bill for $5,000, and some of it's paint, some of it's services. If they're not a corporation, I still should be sending them a 1099. Well, this started out several years ago as a kind of a compliance deal. Compliance meaning they want us, you know, this is how we audit ourselves, and this is how we make sure everybody is complying with the tax law. Because if I got some 1099s, but I didn't file a tax return, they know to come and see me, or if my number is less than the 1099s received. Well, part of, I think it was a trade bill, the transportation bill, one of the bills that passed in June, part of that bill was they increased the fees to $250 per form. So if I'm out there and I have 10 forms, 10 people that I paid over $600 to for services, then I should be sending each one of them a 1099. If I don't, that's $2,500. Oh, but wait a second. I'm also supposed to send a form to the IRS. That's another $2,500. That's $5,000 for 10 forms. And I can tell you, you can talk to your advisor about this. But one of the first things that the IRS looks at after they go through the questionnaires is they look at 1099s because it's easy picking because people don't do them. As a matter of fact, there's a line on the tax return that says, "Did you pay anybody over $600 for services that were not a corporation?" You have to answer that yes or no. And then the second question is, did you give them a 1099? That causes us a little grief because every once in a while we'll have a client that says, yes, I did, but no, I didn't. And so we say, well, we got to mark this no, and you know that's audit bait, and it causes us a little grief from a preparation standpoint. This is a big deal, and so make sure you talk to people. Now, talk to your advisor about this. Now, the other thing is the first time ever we've seen this. We had a client that brought in this summer, maybe two clients, that prepared their own 1099s. We prepare a lot of 1099s, but that prepared their own 1099s, and they sent it in late. And guess what? They got a notice for sending it in late. There's nothing they could do about it. I think it was $50 last year. And so they had like 10 of them that sent late, and it was $500. And that's $500 they didn't need to spend. So we're really talking about 1099s a lot. They need to, but if it's a corporation, you don't need to send it. The other thing that you say, on that 1099, you have to have that person's ID number, Social Security number, or business number. So since you have to have that, one of the things you need is you need to get it. And sometimes here we are, January 15th, and you need to do a 1099, but you can't find the guy or won't give you your ID number. So there's a form, a W-9. W-9, you should just have a stack of them. And anytime you're paying somebody, say, hey, fill out this W-9. It's a backup withholding form. And then you'll have their Social Security number. So that's really important that you do that. This is one of those things that's going to come back and bite some people. It's very expensive. Oh, wait a second. I said not corporations. There's an exception. Veterinarians, I don't care. If they're a corporation, they still should get a 1099 for some reason. Okay? Medical reimbursement plans, man, this was a mess. Have you heard about this Patient Protection Act, Obamacare? Have you heard about that? Man, what a mess. What they did in the Patient Protection Act said that you no longer could have a medical reimbursement plan. So back in the old days, what I could do is I could have a plan, and what I could do is I could pay, if I had 3 employees, I could pay like $5,000 their medical expenses, deductible me, not income to them. It was a great fringe benefit for them. They said, no more of that, no more of that. As a matter of fact, it was kind of against the law, but they really weren't enforcing it until January 1st, 2015. So January 1st, 2015 said no more medical reimbursement plans. And what they did then was they said, you know what, we got a lot of people that aren't following this. They didn't get it. They don't know about it. So I'll tell you what, it's still the law, but you can have a medical reimbursement plan till June 30th, and we won't fine you. It's still against the law, but we won't fine you. The penalty, look at this. The penalty is $100 a day per person up to a maximum of $36,500 per year. So if I had those 3 people and I was doing a medical reimbursement plan, I'd have, what, $100,000 worth of penalties possibly. So they said no more medical reimbursement. Oh, wait. There's an exception. I teach an income tax class to our local college, and just for one class. And I tell them the reason the tax law is so complicated because here's the law and then here's the exception. I can have a 1-person plan. If I only have 1 employee, I can have a medical reimbursement plan for that 1 employee. So now my farmer, my producer who pays his spouse, she's the only employee, he can have a plan for that employee, 1 person, only has 1 employee, and her family, which happens to include him. Or if I have a corporation, I can do the same thing. I can be the only employee of the corporation. So if I only have 1 employee, there's a form that you have to fill out mid-year to record this. And I think there's like a $10 or $2 fee or something like that, which the cost of doing the form is more than the fee. But there is a fee, so you still can do it, but you can only have a 1-person plan. Our ag people are able to do this because most of them don't. A lot of them don't have more than 1 employee, and we can work this. Now, things that I really don't have time to talk about are drought states. I talked a little bit about repair and supplies. Patient Protection Act, I could talk about that till midnight, or tomorrow probably. Record keeping requirements, income averaging, that's still out there for ag people, not for corporations, but ag people. Installment sale rules, man, this is a great opportunity for ag people. Great possibilities. Installment sale rules are great. Problems if interest is refinanced. One of the things that we don't see this very much. So I just mention this a little bit because this is one of those things that a guy can really step on this one and explode on you. Let's say I owe the bank $100,000 my operating loan and $10,000 interest. I haven't sold anything this year, so I go in and say, hey, let's just refinance the full $110,000. Okay. What the rules are that interest is not deducted because you didn't pay it, because you just refinanced it. Now, if I go to another bank and borrow 10 and pay off the interest, and then borrow 110 from my old bank and pay off that other one, that works. But yeah, a person can get in trouble there, especially if you're on a cash basis. Prepaid expenses. Hey, there was a really great case on prepaid expenses this year. It was a big farm in California, that vegetable farm, and they had a whole bunch of packaging that they didn't use. They bought, they hadn't used yet, and the thing was they put it on their financial statement. And the IRS came in and said, hey, you put that on your financial statement, and so therefore you can't deduct that. And they said, hey, we're a farm operation. And they went off to court, and the taxpayer won. So even though we're not vegetable operators, or there may be some on the line, but even though you're not vegetable operators, it proves that there's no limit on the only limit on prepaid expenses. There has to be a business reason, number 1, and number 2, it can't be over 50% of your operating expenses. And so that's good. Forms of business, gifts, leaseback, pension, a lot of pension opportunities out there. Gifts to charity, a product, I love that one. Succession planning, boy, we're starting to see more and more people doing succession planning, and that's hard for producers because they got so many, so capital intense and splitting things between family members, constructive receipt, and our favorite wages in kind. So those are some of the things that if they gave me 6 hours, I'd talk about. I will say that I did probably saw some of you guys down at Cattlemen's College down in Texas this last year. Man, you guys know how to run an event. I get to speak at some different venues, and I don't say this just because I'm talking to you guys. Nobody runs theirs better than you. You guys are so sophisticated, and the food was fantastic. So anyway, that's what I got. Oh, there's my unfavorite joke. The first 2 were for tax fraud. The last 26 are shooting my accountant. I hate that one. Hey, by the way, I do an ag blog. I put it out every week. I put about 4 things on there. If you're interested, it's free. There's my email address. Just email me at lkopsa@kopsaody.com, and I'll put you on the list. And every Monday or Tuesday, we send out a constant contact, and then you can click if you're interested. I'm not sure exactly what I'm talking about this week. I put that out tomorrow. So anyway, if you're interested in that, let me know. If you have any other questions, let me know. If it's a question that is a base question, I answer those. Sometimes you have to know people's situation to answer more complicated questions, so I at least direct you to the right person. So anyway, that's me. I appreciate it. I'm going to turn this back here to Josh. There you go. And thank you, guys. I appreciate your attention.
All right. Well, a big thank you to our presenters, to Larry and Colin and Kent. One of the things NCBA does best is to bring folks together from across the industry and provide the best information available for cattlemen. I think we've achieved those objectives tonight with a great webinar. As we move into our question and answer period, I do want to invite everyone to the upcoming Cattle Industry Convention being held January 27th through the 29th in San Diego, California, my home state. Plan to come a day early or 2 and participate in things like the Cattlemen's College Tuesday afternoon and Wednesday morning. Also, there's some pre-event tours in the area. The entire convention provides a great opportunity to hear more in-depth information on current issues and opportunities in the cattle industry and help chart the course for our future. Now, I'll turn it over to Josh White with NCBA to moderate our question and answer session. And thanks again for participating in the webinar tonight.
All right, folks, if you will, type in any questions you have. I don't have any up right now, but Larry's still on the phone with us, and of course Kent and Colin, so if you have any questions, feel free to type them in the question box on your screen, and we'll get them asked real quickly. And if we don't have any, then we'll wrap it up right quick. So once you start typing, I'll see that you are. I've got a question that just asks a real simple one that I can answer. Can these slides be accessed? The entire recording tonight will be available on our website, hopefully by tomorrow afternoon. If you just go to beefusa.org. We won't share out the slide deck as just a deck, but you will get the full recording and the deck along with it. Any other questions? We appreciate you all getting on tonight. And again, if you have follow-up questions for Larry or Ken or Colin, all of their contact information is also available at each of their websites. So I'm sure they'd be happy to answer any questions. And again, we'd be happy to see you and hope you'll join us in San Diego for Cattlemen's College and then all of the convention activities. You can find all that information at beefusa.org as well. And it looks like that's all for tonight. So thanks again, everybody, and have a great Christmas and holiday season. Thanks for joining us.